So after using the Porter's five forces to analyze Twitter, we found the rivalry among existing firms to be high. And that's because despite Twitter having an established base of followers, niche platform, and significant cultural relevance, the social media industry is still extremely mercurial. And the threat of new entrants for Twitter is going to be medium. And that's because developing and maintaining applications designed to handle a large user base is extremely challenging, especially when considering the substantial amount of brand equity you need to even attract those users in the first place. And a threat of substitute products is high for Twitter. And although there's no single platform to substitute what Twitter does for its users, there are a variety of avenues its users can take to kind of fulfill the need that Twitter does for them. For instance, just major news outlets and various kind of entertainment magazines and things like that. And the bargaining power of buyers for Twitter is going to be high. And that's because the power the buyers have over Twitter is kind of twofold. And although the users aren't the buyers per se, if the user base gets too small, then the advertisers who are actually supplying Twitter with a revenue stream are going to pull out of the platform. And the bargaining power of suppliers is high. That's because the suppliers for Twitter are going to be the users. And if the users become upset with the direction that the platform is taking, they can simply abandon it. And the competitive strategy that Twitter is taking is differentiation. That's because most of the social media sites operate in a fairly analogous business structure where they get their revenue from ads. And this puts Twitter in a position where they need to really differentiate their product in order to stay ahead of the competition. And the Porter's five forces for Cisco, the rivalry among existing firms is high. And that's because Cisco faces a lot of substantial threat from really big competitors like Amazon Web Services, Microsoft, and Hewlett Packard. And the threat of new entrants is going to be low for Cisco. And that's because although there are many ventures that produce products similar to those of Cisco, many of these companies lack a substantial amount of infrastructure that Cisco is gaining through its early mover advantage in the market. And the third substitute product for Cisco is going to be medium. And Cisco has been able to keep this threat down by heavily investing into research and development. And also another great asset that they have is that they have such a large amount of market share that they've gotten through an early mover advantage. 85% of internet traffic travels across Cisco's systems. And the bargaining power of buyers is going to be medium for Cisco. And Cisco's buyers have a range of substitute products to choose from. But with Cisco's constant emphasis on product quality and technological capability, they've really set themselves apart from their competition. And the bargaining power of suppliers is low. That's due to Cisco's size, organization, and substantial market share. They're really able to kind of have a lot of leverage over their suppliers. And the competitive strategy they're using is going to be differentiation. Cisco has continued to provide networking communication services and equipment that are differentiated from their competition through focusing on security and strategic partnerships that enhance the overall value of their products.
All right. So Twitter's goal is to provide value to their users by connecting everyone to their world real time. And the management team has recently been focused on refining their product to become the app for news and information sharing. Now, Twitter has also recently launched an intense effort to dominate the massive live streaming market. However, their purchase of Vine has failed to be integrated into the platform and was ultimately abandoned. However, their second acquisition, Periscope, has fared far better and is becoming an integral part of Twitter's strategy to increase live streaming market share. So, as a free social media platform, Twitter must have a significant daily audience in order to attract advertising revenue. In social media, Twitter is the platform for influencers to connect with their fan base. And while they have grown over the past 5 years, it is been growing too slowly in comparison with its competitors for many investors. Now, financially, Twitter's strategy has recently produced its first profitable quarter. However, since Twitter's initial IPO, they have had a net loss of more than $2 billion, and it has continued to underperform in almost every single measure since their IPO. In contrast, Cisco is the leading innovator and provider of information technology products. And since 1990, Cisco's management team has consistently and reliably introduced successful products and solutions into the marketplace. So Cisco has a three-pronged strategy to continue leading the market in networking products and technologies. The company hopes to unlock the power of data, deploy more secure products, and enable a multi-cloud solution for their consumers. So as the number of new devices that are connected to the internet grows, Cisco solutions will become more vital to the technology industry as a whole. Now, opportunities for Cisco exist in software as a service, platform as a service, artificial intelligence, and virtualization, because as customer demands faster speeds, they'll need to meet the need. Now, to access these opportunities, Cisco has made significant efforts to acquire companies that specialize in machine learning, artificial intelligence, IoT, cloud computing, and analytics. And threats that could erode Cisco's market share are the low barriers to entry that certain Cisco software products have. And larger companies like Amazon Web Services, they have significant resources to compete with Cisco. And other smaller companies like Arista and Juniper have vertically integrated and are able to compete intensively for Cisco's smaller clientele. And also, revenues from enterprise clients have stagnated recently, and Cisco's efforts to increase revenues have not produced abnormal returns.
All right, I'm going to be talking about financial ratios. For this project, we picked 7. And before I get into that, let me explain the graphs so you can follow along. On each slide, we have ratios for both Cisco and Twitter and their competitors. On the left side, you can see Cisco. Cisco's in the blue, Juniper is in the red, and Arista's in the green. On the right side, we have Twitter in blue, Facebook in red, and Snapchat in green. Let's get started. On this first page, we wanted to use these ratios to ask, can these companies independently keep themselves afloat? Can they run their business? Can they pay their debt, etc.? So our first ratio is the operating cash flow ratio. And this asks, can we pay our liabilities with just operating cash flow, current liabilities with operating cash flow? We can see that Cisco is very consistent, that they could pay about a half to 60% of their current liabilities with just their operating cash flow. Twitter has risen a lot where they can pay all their current liabilities with their operating cash flow, but they started off with nothing, so they've grown quite a bit. The second ratio on this page is the net debt to equity. Now, a negative number is not necessarily a bad thing. It means you have more cash and marketable securities than actual debt. So both of these companies have a negative net debt to equity, so they can pay off their debts easy. On to the second page, we wanted to use these ratios to ask how good are these companies at making money. So the first one is the operating return on equity. So this asks, can companies run their core business with the equity that's been given them? So Cisco, again, they're very consistent around 18%. They have an 18% return on their equity. Twitter is finally having a positive return on equity, operating return on equity. They've been in negative for a long time, but finally positive. The second is the end game. It's the net profit ratio. Cisco, consistent, as always, right around 20%. Twitter, still losing money, but we can see that they're losing money less and less and less. And onto this third page, this is for me and you, for investor. These are what I like to call investor ratios. Will you make money by investing in this stock? So on this page, we have Cisco on the top, Twitter on the bottom. First ratio is earnings per share. How much money is your share getting this year? Cisco, Mr. Consistent, is around $2 a share. Twitter, you can see that they're still losing money, but losing less. The second ratio on this page is price to earnings ratio. How much is it going to cost you to get some skin in the game? Cisco, again, is consistent around $13 to make a buck. Whereas Twitter, you're paying to lose money. And the final ratio is stock price. Cisco, you can't really see it very well because Arista's stock price is very high, so it kind of screwed up the graph. But Cisco, their stock price has gone up from about 20 to 30 bucks over the last 5 years. Whereas Twitter, their stock is going down. Started at 50 bucks and is now down in teens. So those are the ratios that we've set up for you.
So we noticed that Twitter is having a problem retaining users, thus explaining the drop in sales in 2017. And we expect this to continue. So we forecasted 2018 sales to drop even further. Twitter's cost of goods sold, research and development, sales and marketing expenditures have been decreasing consistently over the past 5 years, and we expect a continuation of that trend. We also noticed that sales and administration costs have appeared to stabilize around 11.6% of sales, thus that number was used. For other income and expenses, we noticed that the trend appears to increase in favor of income as a percentage of sales, with one huge drop in 2017. So for us, this looked like a fluke. So the 2018 forecast put the trend back on track right where it had left off, which was 1.04% of sales. And we noticed that interest paid was steadily increasing, so the forecast is a continuation of that as well. Now, calculating taxes was easy. Twitter's 10K showed that our effective tax rate was all over the place, and this is because they have never had a positive EBT as a public company. That is until our 2018 forecast. So to forecast Twitter's 2018 effective tax rate, we took a page from Cisco's book. Because they are consistently profitable and have a consistent tax rate to go with it, we figured that for a newly profitable company, we should match Cisco's 12% effective tax rate. So we noticed that Cisco's sales have been very consistent over the last 5 years, while Juniper and Arista's are growing rapidly. And so because of this, a simple average was used to project Cisco's 2018 sales. Cisco's cost of goods sold have also decreased consistently as a percentage of sales, and this forecast is a continuation of that trend. Sales and research and development have also been very consistent, so we just used a simple average for that as well. Now, Cisco's sales and marketing, depreciation, amortization, and other income and expenses, net interest, we notice that they've all been decreasing consistently as a percentage of sales, so this forecast is a continuation of that trend as well. Now, for taxes, we noticed that Cisco's 10K showed that they could consistently get their effective tax rate down to about 57% of the federal corporate tax rate. And this follows a trend with the new 21% corporate tax rate that will take effect this year. So 2018's effective tax rate under this trend is 12%. So for our forecasted earnings per share, we believe that Twitter's EPS will continue to decrease to negative $1.10 as Twitter continues to bleed users and as advertisers leave the platform. However, we believe that Cisco's earnings per share will improve to $2.12 from $1.94 from the year before.
Hi, my name is Cole, and I'll be talking about the accounting policy data for Twitter. Just to get into their revenue recognition, per their 2018 annual report, this is how Twitter defined that they recognize their revenue. They only recognize it if there's persuasive evidence of an arrangement existing, the price is fixed or determinable, the service is performed, and collectability of the fee is reasonably assured. So pretty much what you'll see with everybody recognizing their revenues is just telling you, hey, these aren't fraudulent. We have arrangements that exist. We have so-and-so is going to pay us this much. So just a way to prove that what they're actually receiving and what they're accounting for isn't fraudulent and isn't fake revenues to build up their company. A lot of the revenues come from promoted accounts, trends, and tweets. The promoted accounts will just pop up on people's Twitter feeds regardless of if they follow the account or not. It's on a pay-for-performance basis, so the more impressions that account gets, the more people that visit the account and actually end up following it, increases the revenues that they get for it. And then the trends are a little more on a local basis, so wherever you are in the country or even globally, it'll give you trends based on where you're at, and then still follow through with all the other trends that you see on like the search tab and the moments tab. And then those are on a fixed fee per day basis. So for the entire day, they're fixed fees. And then for the tweets, same thing as the accounts, except for the actual tweets. The performance is just based off retweets, likes, favorites, all that kind of stuff, how many people visit the tweet. And those are just going to show up too based off of what you like, what you've used before. And then with data licensing for Twitter, this is their data products and data license that they offer out to other data partners to use, like their mobile exchange apps and whatnot, so that those data partners can access the search histories and whatnot. And then that's how they get most of their revenues. There isn't any inventory valuation and there's no off-sheet obligation since 2015. But we'll move into real quick on the allowance for bad debts. You can see compared to Facebook, they don't have a lot of bad debt. They're on a much smaller scale, but overall their allowance comparable to Facebook is much smaller, especially since they don't make any money. So that would mean they're a little bit less risky than the larger scale that Facebook is on. They're going to acquire more debt, obviously, when they have more money that comes in. But that is it for my portion on the accounting policy data for Twitter. I'll pass it on to Melissa to complete Cisco's accounting policies and data.
I'm going to be talking about the accounting policies for Cisco. The first thing I want to cover is the revenue recognition. Companies generally have really long ones of this, and it's not going to be any different with Cisco. So I'm going to hit 4 main points. The first one is that there's evidence of an arrangement. This can be through a contract or customer ordering a product. The second point would be that the delivery of something. This can be the delivery of the software, the contract, or the customer accepting their purchase. Third point would be a fee. That is basic. Someone paid their bill payment. The final point would be collectability. Is the customer credit worthy? Will they pay their bill? So those are the 4 important things to set up to make sure that they have revenue or what accounts for revenue for Cisco. The next policy I want to talk about would be the inventory valuation. Cisco deals on a first in, first out method. That's how they do it. And they base their inventory written down by excess and obsolete inventory. That helps them to determine what their future demand might be for their inventory. The reason that this is important to know is because if you put the inventory wrong on one income statement, it's going to carry over to the next one as wrong because the final one carries to the beginning, and it will mess up all your numbers. The allowance for doubtful accounts is the next policy that we're going to cover for Cisco. They determine it by the collectability of their customers. They're constantly going over it. They're always reviewing it and adjusting it for what they need to in that year. For 2017, their uncollected accounts came to about 4% of their full accounts. And throughout the full 5 years, they generally have stayed in the 4 or 5% range. When you compare this to their competitors, such as Arista and Juniper, they are very much higher. These other companies are doing lower, and this means that they are collecting more of their revenue. They're not having the issues with uncollectible revenue that Cisco seems to be having. The final policy that I'm going to cover is the off-balance sheet arrangement. Cisco considers their investments to be variable interest entities for their off-balance sheet, and they like to invest in privately held companies. They're constantly evaluating this and constantly looking over their investments to adjust fit for it And as of the end of July 2017, they didn't have anything to report from their off-balance sheet.
I'll be talking about the market segmentation of Twitter and Cisco. Twitter has about 330 monthly active users and seeks to monetize this asset. They do so with two main products. Number one, with their advertising, and number two, with their data licensing. Their advertising does earn the majority of their revenue, with about 85% earning about last year $2.1 billion, and their data licensing making up the rest of that with 15% earning about $333 million. Twitter also divides up its market into three main geographic locations. Number one being the Americas, the United States, and number two being Japan, and the third being the rest of the world. The US does make up most of its revenue with about 57% earned here in the US. Moving on to Cisco. Cisco does divide up its market into two main sources of revenue as well. The number one being the sale of its physical goods, and number two, the sale of its services. Their products, physical products, do earn the majority of its revenue with about 75%, last year earning about $35 billion, and the rest of its 25% earned by services with about $12 billion. Cisco also divides up its market into three geographic locations. Number one, the Americas. Number two, what they call EMEA, the Europe, Middle East, Africa, and the third being APJC, Asia Pacific, Japan, and China. They do have headquarters in each of these locations to manage these areas locally and more effectively. The Americas and the American market does earn the majority of its revenue with about 59%. Thank you.
Hello, I'll be going over our CEO compensation. And first of all, we're going to get started with Cisco Systems, Inc. Their current CEO is Charles Robbins. And in his last year, his total compensation was roughly $16.7 million. And we're going to compare Cisco to its two competitors, Juniper and Arista Networks. First, we're going to take a look at Juniper Networks. Their current CEO is Rahmi Rahim, and his total compensation for the year 2017 was $9.4 million. And we're going to look at Arista Networks, another competitor for Cisco. Their CEO's compensation, her name is Jasheri, was roughly $3 million. And we'll pull up the slides for you guys so you guys can take a look at the breakdown, take a look at Cisco, and then take a look at Juniper and Arista and see where mainly their compensation is coming from. So by looking at all three of the CEOs and we took a look at their proxy statements, we noticed that most of their compensation for their CEOs, it comes from their stock awards and their option awards. And we believe that Cisco, essentially, they are in line with their competition. And we're going to take a look at Twitter now. So we're going to switch on over to that company and take a look at CEO Jack Dorsey. He is the current CEO of Twitter. His total compensation for the year 2017 shows zero. In 2016, his total compensation was $56,551. Jack Dorsey, he owns roughly about 2.4% of Twitter's total shares, and once again he took no salary in 2017. And we're going to compare Twitter to its competition Facebook. So CEO Mark Zuckerberg, total compensation was roughly $5.7 million. And we're also going to take a look at Snap Inc. and their CEO Evan Spiegel's total compensation last year was roughly $637 million. And we'll pull up those slides for you as well, just right above me, and show the breakdown on where their compensation is coming from. So we believe, by looking at the numbers, we believe that Twitter is in line with its competition because the compensation the CEOs are receiving, it is mainly coming from their stock. And Twitter, they've kind of taken the approach of the dollar salary for their CEO, and that's exactly how their competition Facebook is receiving majority of their compensation as well. And just to wrap things up for you guys, we believe Cisco and Twitter, that both companies are in line with their CEO compensation.
So after thoroughly analyzing both Twitter and Cisco, it became blatantly apparent that Cisco was the better investment choice pretty much across all factors. And when conducting the Porter's Five Forces analysis on both companies, it was easy to see that Twitter was far less established company in its industry and still had a long way to go to catch up to the industry leader of Facebook. And many of the threats that Twitter faced were simply due to the fickle nature of the social media industry. along with a high level of direct competition from a lot of really big players. And both Twitter and Cisco are in industries where staying on top of the technology curve is a must. However, Cisco's large size and substantial influence within its industry definitely set it apart from Twitter and allowed the company to decrease a lot of its potential threats. Financially, Cisco is a far superior investment choice when compared to Twitter. Cisco has maintained a healthy average operating return on equity of 18.3%, while Twitter's numbers are still in the negative for that. And Cisco's management team has been able to create a reliable and profitable company with consistent earnings per share while steadily increasing their price per earnings ratio. And Twitter has been steadily increasing its profitability over the past 5 years, but has had a negative profit per earnings ratio since the company's inception and has actually been getting worse over time. And to further exemplify this kind of disparity between these two companies, over the past 5 years, Cisco was able to increase their stock's price's value by 63%, while Twitter's stock price faced an all-time low this past October. And Twitter is a relatively new company and has generally been increasing its financial appeal. However, the profits the company has been making along with its size and leverage in this industry totally pale in comparison to Cisco, which is a far more established player in their industry and consistently profitable.